Hi there! Thanks for tuning in to Canada Accounting Insights. In today's video, we're going to break down the perpetual versus the periodic inventory system in a way that'll help you absolutely lock in these concepts. But before we get into it, make sure you subscribe and give this video a thumbs up. That way, you'll always stay up to date with practical accounting insights. Okay, let's dive right in. Just think about it for a second. From your morning coffee to that giant online order, even the car dealership down the street, every single one of these businesses has to answer the exact same fundamental question. How do we know what we have in stock? It's really the core problem that these inventory systems were designed to solve. Okay, so here's the game plan for our little study session. First, we'll cover the basics. Then we'll introduce our two main players, the perpetual and periodic systems. After that, we'll put them side by side, and that part is super important for your understanding. And finally, we'll talk about why a business would choose one over the other. Let's get to it. Okay, first things first, what are we even talking about here? To put it simply, if a business sells stuff, it needs a reliable way to keep track of what comes in the door, what goes out, and what's still sitting on the shelf. And that basic leads us to two very different approaches, two completely different ways of thinking about it. All right, first up in the ring, the perpetual system. Honestly, the best way to think about this is like a live scoreboard at a football game. Every single time something happens, a sale, a purchase, the score updates instantly. You always know exactly where you stand, right down to the second. Okay, here's the more, textbook definition you need to know. The keywords you gotta remember are running real-time balance. It means the official accounting records, the general ledger, are constantly being updated perpetually, you might say. So your inventory levels and your cost of goods sold are always current. So what are the trade-offs, right? Well, the huge advantage is having that data up to the minute. A manager can see what's flying off the shelves and what's not. And they can spot problems like theft or shortages like that. But the big downside, it costs more. You need the whole thing, computers, barcodes, runners software to track every little thing, and that takes cash and a lot of effort to keep running. Okay, let's get into the journal entries and listen up, because this is where you're going to notice the difference between these two inventory systems. When a business using the perpetual system buys new products, the entry is super clean. See that it's a direct debit right to the inventory account. Those new items are immediately on the books as an asset. Simple as that. And this right here is the absolute game changer. I'm serious. When you make a sale with a perpetual system, you make two journal entries. The first one, that's easy, it just records your revenue. But right away, you make a second entry. This one records the cost of goods sold and takes the item out of your inventory. So the main takeaway is the expanse, and the reduction in inventory happen at the exact same moment as the sale. Okay, time to bring in contender number 2, the periodic system. So if perpetual is that live scoreboard, periodic is like not looking at the score the entire game. Instead, you wait till it's all over, and then you just check the final box score to see who won. You're not tracking every little play, you're just counting everything up at the end. And here's the official definition for you. The absolute key phrase here is, does not keep a running balance. All the important math happens at the end of the month or the quarter or whatever the period is. That's when the business sends people out to do a full physical count of every single item to figure out what's left, and only then can they work backwards to figure out what they sold. The trade-off here is pretty stark. On one hand, you get this awesome simplicity, and it's way cheaper, but the downsides are huge. Your information is always old. A manager has no real clue what the inventory levels are in the middle of the month, so it's really tough to make quick, smart decisions until that big physical count is finally done. All right, back to the journal entries. Let's see how different this is. When you buy inventory under the periodic system, you don't even touch the main inventory account. Instead, you can see it right there. You debit this temporary account called purchases. All the stuff you buy during the month just gets piled up in there. And what about when you make a sale? Well, it's way simpler. There's only one entry to make record the revenue. That's it. See what's missing there? Yeah, there's no second entry for cost of goods sold. Why? because at that moment the system has no idea what that item cost. It won't find out until the big count at the end of the period. Okay, you counted your inventory in the end of the period. Now it's time to determine your cost of goods sold. The cost of goods sold is determined by subtracting the inventory at the period end from the sum of the opening inventory and net purchases during the period, like you see in the formula. Just a reminder that shipping costs are recorded as debit to purchases, typically a freight-in subaccount, and it's included in the determination of net purchases. All right, we've met our two fighters. Now it's time for the main event. This is really the heart of what you need to know, so let's put them head to head and see how they stack up. This slide really just boils everything down to one big idea. Perpetual is a movie. It's continuous, it's real-time periodic, is just a single snapshot, a picture taken at the very end. If you can remember that, you've got the core concept down. Okay, people screenshot this, write it down. Whatever you gotta do. This table is your ultimate cheat sheet. Let's run through it fast. A purchase, perpetual hits inventory, periodic uses that purchases account. Now the sale, this is the big one. Perpetual has that all-important second entry for cost of goods sold periodic. Nope, nothing there. And even on returns, they use different accounts. Okay, so we've gone through all the mechanics, the journal entries, the whole thing. But you might be asking, why doesn't everyone just use the real-time one? I mean, it seems better, right? Well, this gets into real-world business strategy, and it's a great concept to understand. Well, it really all comes down to what kind of business you're running. If you're selling expensive stuff, like electronics or cars, you absolutely need that tight control and real-time data you get from a perpetual system. But if you're a small corner store selling thousands of cheap pieces of candy, the cost and effort of that fancy system probably isn't worth it. A simpler, cheaper, periodic system just makes more sense. All right, to wrap this up and really make sure this stuff sticks in your mind, let's do a little thought experiment. Picture a brand new company selling expensive high-tech drones. Now picture a small local bookstore with thousands of different paperbacks. Which system should each one choose, and what's the single biggest reason why? If you can answer that, you've totally got this. Thanks for watching this video. See you in the next video where we are going to talk about how to estimate inventory using different methods like retail and gross profit. Stay tuned for more.